Stock markets are listless, but that may not last for very long after these Nvidia earnings overnight. But there's more than meets the eye than just what's happening in stock markets, because there's maybe a whole other interesting trade on the board despite the shenanigans happening in equities and allowing us not to have to guess where the next S&P 500 or NASDAQ move is going to be. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And what we're going to focus on today is something that sets up as an opportunity, perhaps, outside of the back and forth on whether we believe in NVIDIA's AI narrative, whether their earnings beat was good enough or not good enough for market expectations, and take ourselves to look at the euro, which has, over the past several weeks and even months, but especially over the past several weeks, accelerated to the highest level in over a year. And ask ourselves, does this make sense? And is the euro now too expensive and ready to go in the opposite direction? And we'll start just by anchoring ourselves in what the price action looks like. We'll notice here that from about mid-April or so, lows above 106, 106.29 there, the bottom. This is the continuous contract for 6E futures, so euro in terms of US dollars. And we can see that the move higher starts then. Here's mid-April right here. And of course, when we get the beginning of August, we surge and get from 108 very quickly to just above 112 until this misstep, where we seemingly lose the capacity for this stair step higher. Notice this move up, then a correction, then up, then we hold where this former top was, then up, a correction, we hold where the former top was, and then don't. So something here may be starting to lose momentum. It is, of course, noteworthy that we tried to get back over this high from late last year and have now fumbled back under. So perhaps some signs of capitulation and a much more convincing sort of setup than a lot of the sort of hazy developments that we see around other markets, and especially U.S. equity markets, where things are still sort of shrouded in sentiment-related volatility concerns. So as we look at this, the first refreshing and encouraging thing about a trade like this and a setup like this is that the euro seems to be trading in line with what is the most textbook explanation for why currencies go up and down. So this is not so much a story about sentiment. This is not a story about whether one believes the AI hype or doesn't. It's a simple story of interest rates. Looking at the lighter colored line here, that's the spread between German and U.S. 2-year bond yields. In other words, short-term interest rates in Germany relative to the U.S. Germany, of course, the stand-in for the Eurozone writ large. That's the largest economy there and sort of the benchmark for regional assets. So what you're getting here is essentially the cost of borrowing spread between the U.S. and the most eligible borrower and the largest economy in the Eurozone. And what you see here is, with the start of the rate hike cycle in 2021, that line, that spread, starts to aggressively move against the euro. And in the darker line, of course, is Euro USD itself. And you can see that, of course, it begins to sell off. The Fed starts to signal right here that it's going to have to hike rates, that inflation isn't a transitory thing. This, of course, comes out of the pandemic. This surge in this spread, just for reference point, is where the Fed announces open-ended QE because we're in the middle of the COVID outbreak right here. The recession ends, we get inflation, and right here is where the Fed says, okay, we're ready to do something about it. They go on a rate hike cycle. Notice, by the way, much of the move happens before that rate hike cycle even starts because markets, of course, are forward-looking. Here's the extension of the move. It runs into the beginning of 2023. And then we turn in the opposite direction. What's interesting about this is it seems to essentially reflect a kind of normalization in what this was, and start to suggest that maybe the dollar's yield advantage would not be quite as profound going forward because the rate hike cycles seem to be starting to wind down. And most encouragingly here, we can see that the price action continues to trade in lockstep for the most part. Can't really expect these cross-asset relationships to be perfect, because, of course, they're different assets, and one is a spread and the other is a currency. So one is essentially today in time and one is 2 years forward in time, and there's different liquidity considerations. So you can't expect these things to be perfectly in line tick for tick, but we can clearly see that as relative monetary policy bets go, so too Euro USD appears to move. So very refreshingly here, this is how you might expect an exchange rate to behave reading the opening pages of a textbook on currency markets. Now, the most recent upswing here is this. And this is mid-April right there. So this low right there, that's the same one as this right here. So this upswing is this upswing. What happens there? Well, U.S. economic data starts to deteriorate relative to forecasts. And so what you start seeing is a reshuffling for a more dovish outlook on Fed monetary policy. You can see that here. Mid-April or so, you get the sense that the Fed is going to be reluctant to cut because it's worried that inflation numbers aren't going down fast enough. And so what you get is an anchoring of rate cut expectations, a sort of benchmarking of them for this year, at least at that time, until we get into these sentiment-related shenanigans in July. But the overall tally of rate cuts between this year and next year starts to build out. And so what you're getting is essentially a dovish shift in Fed policy expectations relative to that of the ECB. And because you get that dovish shift, you can see the yield spread goes up and the euro goes up with that yield spread. Now, of course, in the middle here, what you have is an ECB rate cut in June, but that rate cut was widely expected. And so what you have here then is, here's the start of June. You get this slight fuzziness around the rate cut that occurs on June 6th. And then the euro very quickly bottoms and starts to continue higher. So you can very clearly see not a shocker of a rate cut, nothing much more for speculation to work from, but this is significant. And so the spotlight basically for the better part of 4 months here is on the Fed adjustment, while the situation at the ECB stays relatively static. But of course now, we are fully baked in for the start of Fed rate cuts. This is not exactly the world's biggest debate at this point. In fact, over the course of July, we've heard over and over and over and over from various Fed officials, most critically Jay Powell, but also in large announcements and large publications. It begins at the start of July with Powell's testimony in Congress, where he tells officials that the Fed has gotten to a place where its balance of risks calculus now sees the risk of unemployment being too high as very close to on par with inflation being too high, which is a very different sort of way of thinking versus we need to bring inflation down. Don't worry about the labor market. The labor market's fine. Now it's, well, maybe we're going to have unemployment that's too high. And that, of course, tells the markets the cuts aren't just something on the horizon eventually. Now they are an immediate next step of policy. And we can see right here, by the way, how the market responds. It says, uh-oh, we've thought you need extra rate cuts this whole time because you were delaying. And while that's good for risk taking in stocks, at least for a while, once this becomes immediate, well, then the implications of this logic kick in. You say, all right, well, if the markets thought the Fed would need to cut more in 2025 because of its delay in 2024, it's because the market already thinks the Fed is late to cutting in the face of what is an emerging recession risk. So when the Fed finally says, okay, we're ready to cut, the market says, the risk to growth has become so obvious that even Fed officials are spooked now. Let's take some risk off. And we get this decline, which of course benefits from disappointing CPI data, disappointing jobs data, and we get this slide. Notice that through this entire move, the actual tally of rate cuts doesn't actually change very much. Through the bulk of the sell-off, you level down to a 2% total, which essentially says that between this year and next, 2% will come off U.S. interest rates. And if we take a look at where that shakes out now, it's 83 basis points this year and another 118 basis points next year. In other words, 3 rate cuts with optionality for 4 this year and 4 with optionality for 5 next year. So as we look at what this is then, the speculative part of this story appears over. It looks like we're about done benchmarking just how dovish of a shift in Fed policy there is likely to be with this weakening data. It seems to be relatively anchored around this 2% level at this point, and now we're just wondering if we're going to get more of it this year or more of it next year. If we look at how it's benchmarked at this point, a month ago it was overwhelmingly more of it next year, 80+% likelihood of a single rate cut, which would be down to the 500 to 525 basis point range, 25 basis points off the current one, which is 525 to 550, less than a 20% chance of a bigger 50 basis point cut. Since the volatility, notice this 1 month screenshot is July the 26th. The next one is a week ago, which is August the 21st. And now, over the past week, day, and today, you start to see consistency, where you anchor at around 60% chance for a single-sized cut, 40% chance, give or take, for a double-sized cut. And we can see here that over the past week, over the past day, this has stood basically still, suggesting speculation is now drained from this, and we're not going to get any more of it basically until next week. The PCE number is due on Friday. We'll talk about it tomorrow in detail here on Macro Money. But the big risk in this story now, before September's FOMC meeting, is probably the jobs report, which is a week from this Friday. So speculation about how much more dovish, less dovish the Fed is going to be, and whether the 50 or the 25 is the size of cut that's coming, that speculation is probably pushed forward in time somewhat. It's probably not coming for a while. Whereas if relative monetary policy expectations are what is in focus here, then the next bit on the ECB side of the ledger should be interesting. And here we have event risk due in just a few hours. First, we're going to get numbers out of Germany, and then the following day on Friday from U.S. Thursday overnight into Friday, we are going to get Eurozone inflation data. We're looking at the catch-all number here, but the German one is essentially a preview and an early vision of the same thing. We're looking for inflation to cool considerably down to 2.2% year on year on region-wide CPI. That would be the lowest in 3 years, and a notable step forward after this kind of struggle to get things moving so far in the first half and into the third quarter of this year. We can see disinflation had a really spirited run last year and now has kind of anchored a little bit as these energy costs in the gray, that's housing, water, electricity, and gas, and most of this is shock of shocks, electricity and gas, as this rebases. There was obviously a spike here with the war in Ukraine breaking out in 2022. That has now rebased with these negative year-on-year readings out of the calculations. And while that happened, this sort of got stuck. Now it looks like we're back to the previously scheduled program here. And so we're expected to slide down to a 3-year low. We can see by July's inflationary makeup here, most of it is still in this very cyclical hospitality category, and everything else is starting to come off. Even this recreation category, which was a major contributor, has now eased back, incidentally, as expected. We've talked about the cyclical concerns in the euro area being something that was likely to unwind these elevated readings on this side. And of course, readings for things like food and energy have also come in considerably. And so at this point, it's hospitality that's the main holdout. And we can see that the growth story seems favorable for further disinflation, given the cyclical nature then of the stickiness here. Now, we did get a little bit of a pickup in the August PMI numbers for the region. So we slumped down to basically no growth at all in July. That's after 2 months of deceleration. This is the composite PMI index. Of course, as ever, 50 is neutral. Above 50 is growth. Below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. Manufacturing, of course, has been anemic and in contraction territory going all the way back to the first half of 2022. But services has been clearly the powerhouse moving the overall composite. And we can see that as services rolled over here near the first quarter, after this shallow rebound from a recession late last year, or near recession, what felt like a recession late last year, we have that rebound fizzling and down to neutral, seemingly, again, a little bit of a perking up in August, but the actual commentary around this from S&P Global in this very PMI release cautions that most of this is France and most of that is build out for the Olympics. So, but for the Olympics giving a boost to France for maybe a month's time here, we really don't have a very positive growth story for the region. So things like hospitality, again, Olympics, that might be relatively quick to fade. Of course, hospitality was elevated before the Olympics too, but without them, we get back into cyclical standstill, most likely. In fact, Eurozone economic data, as we see here, has been increasingly fading relative to expectations. And that has not been lost on markets. This is an index from Citigroup, and we can see that from about March, April of this year, the flow of economic data in the euro area has increasingly disappointed. And from about mid-June or so, it has actually really disappointed and not just cooled relative to forecasts, but still relatively well supported. But here it's actually below zero, and so it's tending to undershoot whatever forecasts are. And you can see that it hasn't been lost on markets because the benchmark German 2-year break-even rate, a measure of inflation baked into the German bond market, has been moving lower for a similar period of time here. So we can see the data starts to roll over right around March, April-ish or so. This is the top. And right here, March, April-ish or so, is where inflation expectations roll over, essentially saying we are watching economic deceleration. That means weaker demand. Weaker demand means less money chasing goods. That means less inflation. So inflation expectations looking out around the 2-year mark here, down to almost 1%. So well within the ECB target range of 2% here looking forward. So the case for rate cuts seems unmistakable. As it stands, we're looking at 61 basis points being baked in for the rest of the year. So we have here before June's rate cut, 67 basis points. We get the cut, and now we can see we've reloaded by an almost further one more cut back to where we started. In other words, since this cut, the market now thinks a still further cut is back into the mix. And so we're baked in for at least two of them, 50 basis points. And at 61, we have 14 basis points toward another third one that would make it 75. That's already in the market, which essentially means that the third cut is carrying a probability of almost 50-50, just over, about 56%. If we look at how this is laid out across incoming ECB meetings, we can see the cut for September is there with about an 80% likelihood, and then we get the remainder of it here. So another cut and some change by December after this one. The interesting thing, if we get inflation missing, is that this could become a 50 basis point cut, and this could become 75. As a matter of fact, at Jackson Hole, the Fed's symposium last week, ECB policymakers started to float the idea of maybe a 50 basis point rate cut in September. All of which is to say, if this misses and comes in even weaker than anticipated, which the flow of economic data has tended to be doing for the past, about 2.5 months or so at minimum here, then this could be the start of a significant reversal lower. because speculation on the Fed side of this spread is probably spent for now. But on the ECB side, it has the opportunity to move in mere hours and could stack up to give us a sizable opportunity for a decline in the very near term. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and where we are likely to head thereafter. I am on later today, in just 30 minutes time here, on the price of truth with Victor Jones. Definitely come check that out. Back on with Chris on Friday for Futures Power Hour. Back with Victor and Tom for First Call on Sundays. Writing for the news and insights portion of tastylive.com. And opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Macro Money is back tomorrow. Price of Truth is in 30 minutes. See you there.